What if the biggest financial opportunity of this decade is being triggered by the most dangerous geopolitical shift of our lifetime? In the last few days, the world has watched advanced weapons challenge modern defense systems, energy choke points move back into the danger zone, and global tensions rise at a speed few predicted. But while headlines focus on missiles and military strategy, the financial markets are telling a deeper story, one written in gold and silver. This script breaks down what's really happening beneath the surface, why gold is pushing toward historic breakout levels, why silver could move even more aggressively, and how oil volatility, inflation risk, and central bank constraints are converging into a structural shift in global risk pricing. This isn't just about a temporary spike in precious metals. It's about a potential permanent repricing of uncertainty. If you care about protecting your purchasing power, understanding safe haven assets, and staying ahead of macroeconomic turning points, this matters to you. The objective here is simple: connect the geopolitical dots, decode the market signals, and help you see whether this breakout is noise or the beginning of something much bigger. Let's step into the data, the strategy, and the implications, because what happens next could redefine how investors think about risk for years to come. What if I told you the global financial system just crossed a line? It can never uncross, and almost no one in the mainstream media is explaining what it really means. As I record this, gold prices are exploding toward a critical breakout level, while silver is surging in lockstep. These are not ordinary market moves. This is not a routine rally fueled by speculation or short-term hype. This is a structural shift in the global economy, triggered by a chain reaction of geopolitical shocks that are rewriting the rules of risk, defense, energy, and capital preservation in real time. In the last 24 hours alone, the world witnessed a hypersonic missile deployed in active combat for the first time. The weapon reportedly maneuvered mid-flight at extreme speeds, evading advanced missile defense systems designed to intercept conventional ballistic threats. Military analysts have openly admitted what many feared. Modern interception systems struggle against maneuverable hypersonic glide vehicles. That single event did more than alter military doctrine. It shattered a long-standing assumption embedded in global risk models. And when foundational assumptions collapse, markets do not adjust politely. They reprice silently. Investors around the world are waking up to a reality they hoped would never materialize. The cost of war has changed. The effectiveness of defense systems is being questioned, and strategic choke points like the Strait of Hormuz are once again at the center of global energy security. Nearly a third of the world's seaborne oil passes through that narrow corridor. Any disruption there sends immediate shockwaves through crude oil prices, inflation expectations, and currency markets. This is why gold is breaking higher. Gold is not merely a commodity. It is the world's oldest safe haven asset. It carries no counterparty risk, no earnings reports, no debt obligations. When geopolitical instability spikes, when oil prices surge, when inflation threatens purchasing power, capital flows into hard assets. That's not theory. That's centuries of financial history repeating itself. But this time feels different, because this is not just about missiles or oil tankers. It is about perception. It is about confidence. It is about the realization that technological deterrence may not be as absolute as previously believed. When global investors begin questioning whether defense systems can guarantee stability, they reassess exposure across equities, bonds, currencies, and they hedge aggressively. Central banks have already been accumulating gold at record levels over the past 2 years. Retail demand for physical metals has remained strong. Industrial demand for silver, particularly in energy infrastructure and electronics, continues to rise. Now, geopolitical escalation adds a fresh catalyst to an already tightening supply-demand equation. And here's the part most people are missing. The breakout level gold is approaching is not random. It represents weeks of heavy resistance, a zone where institutional sellers repeatedly attempted to cap the rally through futures contracts and short positioning. Each attempt pushed prices down temporarily. Each attempt failed to reverse the broader trend. That tells us something important. Buying pressure is not speculative froth. It is persistent. It is structural. And if that resistance collapses decisively, the next technical target sits at all-time highs, a psychological milestone that could trigger another wave of momentum-driven capital inflows. Silver, historically more volatile than gold, often amplifies these moves. When gold enters price discovery mode, silver tends to follow with leverage. That dynamic has played out repeatedly during previous geopolitical crises and inflation cycles. So here we are, hypersonic weapons reshaping military strategy, oil markets on edge, religious and political tensions escalating, safe haven assets surging toward breakout territory. This is not just another news cycle. This could be the beginning of a long-term repricing of global risk. In the next chapter, we will dissect the military developments that triggered this shift, examine why traditional defense systems may be struggling, and connect the dots between battlefield technology and financial markets. Because what happened in the skies may be only the first domino to fall. For decades, global stability has rested on a single, powerful assumption. Advanced military defense systems could neutralize most large-scale threats before they spiraled out of control. That assumption is now under scrutiny, and the financial markets are reacting faster than governments can respond. The recent deployment of maneuverable hypersonic missile technology has exposed a vulnerability that military analysts have quietly debated for years. Traditional missile defense systems are built on predictive tracking. They calculate a ballistic arc, determine the intercept point, and deploy countermeasures accordingly. But hypersonic glide vehicles don't follow predictable arcs. They travel at extreme speeds, adjust trajectory mid-flight, and operate in altitude bands that complicate interception. When footage surfaced showing advanced interception systems failing to neutralize incoming threats, it did more than alarm defense experts. It signaled to institutional investors that the balance of power, and therefore the balance of risk, may be shifting. And when risk becomes unpredictable, capital moves. Let's break down why this matters for financial markets. Modern global trade depends on stability. Insurance models, commodity pricing, shipping logistics, and even sovereign credit ratings rely on probabilistic risk assessments. When a new weapons platform demonstrates the ability to bypass high-cost defense systems, it disrupts those models. Suddenly, infrastructure once considered secure military bases, energy depots, shipping routes, carries higher perceived vulnerability. One strategic focal point amplifies that vulnerability: the Strait of Hormuz. Roughly 20 to 30% of global oil supply transits through this narrow waterway. Even limited disruptions can send crude oil prices surging. Futures markets immediately begin pricing in worst-case scenarios: restricted flow, naval standoffs, tanker rerouting, or direct strikes on energy infrastructure. Oil prices feed directly into inflation expectations. Higher crude prices translate into increased transportation costs, elevated manufacturing expenses, and ultimately higher consumer prices. Central banks, already navigating fragile post-inflation recovery cycles, face a dilemma: raise interest rates further and risk recession, or tolerate rising inflation in order to stabilize economic growth. There is no painless option. This is where gold thrives. Historically, gold performs strongest during periods of policy uncertainty and geopolitical escalation. When central banks appear constrained, unable to act decisively without triggering unintended consequences, investors seek assets insulated from policy error. Gold has no earnings reports to disappoint, no central authority controlling supply through interest rate decisions. It becomes a hedge against systemic miscalculation. Silver enters the conversation from two angles. First, as a precious metal, it mirrors gold's safe haven demand. Second, as an industrial input used in electronics, defense manufacturing, renewable energy systems, it benefits from increased production cycles during geopolitical tension. That dual demand structure creates an asymmetric setup when crises intensify. But here's the deeper layer. Defense economics are shifting. Reports suggest that relatively inexpensive drone technology has successfully targeted high-value installations, including advanced radar systems. When low-cost assets can disable billion-dollar infrastructure, it alters the cost-benefit calculus of warfare. That imbalance favors offensive scalability over defensive protection, a development that makes long-term containment more difficult. Markets are freaking. If investors conclude that asymmetric warfare lowers the threshold for escalation, they begin pricing in prolonged instability. Prolonged instability means sustained volatility across equities, currencies, and commodities. Volatility increases demand for hedging instruments, and precious metals are among the oldest hedges in existence. Meanwhile, central banks in emerging markets have been steadily reducing US dollar reserves in favor of gold accumulation over recent years. That trend was already in motion before this latest escalation. Geopolitical fragmentation accelerates that diversification. Nations observing heightened sanctions, risk, or regional instability may further increase gold reserves as monetary insurance. So the breakout in gold is not purely reactive, it is cumulative. Years of central bank buying, tightening physical supply, growing industrial silver demand, now layered with a sudden escalation in military uncertainty and energy security concerns. Each factor alone would support higher prices. Combined, they create pressure against technical resistance levels that have capped rallies in the past, and that pressure is building. In the next chapter, we will shift from military implications to the economic choke points that could amplify this crisis, particularly energy markets, inflationary shockwaves, and the fragile positions central banks find themselves in as oil volatility rises. Because if the battlefield triggered this surge, the energy markets may determine how far it ultimately goes. If hypersonic weapons cracked the illusion of military certainty, oil markets are threatening to shatter economic stability. Here's the uncomfortable truth. Modern economies do not run on optimism, they run on energy. And when energy supply is threatened, everything else begins to wobble. At the center of this unfolding crisis sits the Strait of Hormuz, one of the most strategically vital waterways on Earth. Roughly a quarter of the world's seaborne oil flows through this narrow corridor. Tankers pass through daily, feeding refineries across Asia, Europe, and North America. Even a partial disruption sends immediate tremors through crude oil futures markets. Now imagine insurance premiums rising overnight, shipping routes rerouting, naval escorts increasing transit times, traders factoring in the possibility, not certainty, but possibility of prolonged disruption. Oil doesn't need to disappear to cause a shock. It only needs to become uncertain. And uncertainty is inflation's favorite fuel. When crude prices spike, transportation costs climb. Airlines hedge fuel at higher levels. Trucking companies pass costs downstream. Manufacturers adjust pricing to protect margins. Grocery stores feel the ripple. Utility bills follow. The result: inflation expectations rise before the physical shortage even materializes. This creates a policy nightmare. Central banks, particularly the US Federal Reserve, have spent the last 2 years attempting to cool inflation without triggering deep recession. But an oil-driven inflation surge is different from demand-driven inflation. You can't fix a supply shock with interest rate hikes alone. Raise rates aggressively, and you risk crushing growth into contraction. Hold rates steady, and inflation regains momentum. Cut rates, and currency weakness compounds import costs. There is no clean solution. Historically, during periods of oil embargoes or geopolitical energy crises, such as the 1970s supply shocks, gold entered multi-year bull markets. Why? Because oil-driven inflation erodes purchasing power rapidly, and gold acts as a hedge against currency debasement. But this time, the stakes may be higher. Global debt levels today are significantly larger than they were during previous oil crises. Governments are carrying elevated fiscal deficits. Higher interest rates strain sovereign budgets. That means policymakers have less room to maneuver. And when governments are cornered, investors look for assets outside the system. Gold benefits from monetary instability. Silver benefits from monetary instability and industrial demand. Here's where it becomes more complex. Energy transitions are accelerating worldwide. Nations are investing heavily in renewable infrastructure, electric vehicles, and grid modernization. Silver plays a critical role in solar panel production, electrical conductivity, and advanced electronics. A sustained oil shock could paradoxically accelerate renewable energy investment, increasing silver demand, precisely as safe haven flows also rise. Dual demand pressure. On top of that, mine supply cannot adjust quickly. Opening a new precious metals mine takes years, sometimes a decade, due to regulatory approvals, infrastructure development, and capital expenditure cycles. Supply is relatively inelastic in the short term. So if investment demand spikes and industrial demand remains firm, inventories tighten rapidly. This is how structural breakouts happen, not because of a headline, not because of social media hype, but because supply cannot match accelerating demand under stressed conditions. Meanwhile, currency markets are reacting quietly. When geopolitical tensions escalate, the US dollar often strengthens initially due to its reserve status. But prolonged instability combined with fiscal strain and energy-driven inflation can weaken confidence in fiat currencies over time. If global central banks continue diversifying reserves into gold, a trend already visible in recent years that adds a steady bid underneath the market, Now layer all of this together: hypersonic weapons challenging defense assumptions, energy choke points under pressure, inflation risk resurging, central banks constrained, industrial silver demand resilient, mine supply inflexible. This is not a typical short-term volatility event. This is a structural convergence of risk factors, and markets are beginning to price it. But we haven't reached the turning point yet, because the true climax of this cycle will not be decided solely by oil prices or military technology. It will hinge on whether financial markets interpret these developments as temporary turbulence or the beginning of a permanent repricing of global security risk. In the next chapter, we reach that inflection point. We will examine the technical breakout levels in gold and silver, why institutional short positions are vulnerable, and how a decisive move toward all-time highs could trigger a cascade effect that forces sidelined capital back into the market. Because once resistance collapses, markets don't move slowly, they accelerate. There are moments in financial history when charts stop being technical diagrams and start becoming psychological battlefields. This is one of those moments. Gold is not just climbing, it is pressing against a level that has rejected price advances repeatedly over recent weeks. This resistance zone has acted like a ceiling, where institutional sellers increased short positions and futures contracts were used to contain momentum. Each rally attempt was met with aggressive selling. Each pullback shook out weak hands. But something is different now. The selling pressure is no longer pushing price meaningfully lower. Buyers are absorbing it. That tells experienced traders one thing: the supply at that level is thinning. In market structure terms, repeated tests of resistance weaken it. Every time price revisits a ceiling, some sellers exit their positions. Eventually, the remaining supply cannot match persistent demand. When that imbalance tips, breakouts happen, and they happen fast. This is where we are. If gold clears this resistance decisively and sustains above it, the next technical target sits near all-time highs. That matters for one critical reason. Above all-time highs, there is no historical overhead supply, no trapped investors waiting to get out at break-even, no prior congestion zones to slow momentum. Traders call this price discovery. Price discovery is powerful because it triggers a feedback loop. Momentum traders enter algorithmic systems, detect breakout signals, and allocate capital automatically. But silver has an additional layer of volatility because of its dual identity: precious metal and industrial input. If investors rush into safe haven assets while industrial demand remains intact due to defense production and energy infrastructure build-outs, silver experiences synchronized demand pressure. Now consider positioning data. Institutional short interest typically increases near resistance levels as traders attempt to fade rallies. If this breakout invalidates those positions, margin pressure builds quickly. Forced covering accelerates momentum. Retail investors, observing headlines about new highs, re-entered the market out of fear of missing out. Sentiment flips. What was dismissed as a temporary geopolitical spike becomes reframed as the beginning of a larger bull cycle. But here is the key revelation, and the reason this moment matters more than previous breakouts. This rally is not being driven by speculative mania. It is supported by structural factors: central bank gold accumulation, constrained mine supply, resilient industrial demand for silver, rising geopolitical uncertainty, and renewed energy inflation risk. When technical breakouts align with macro fundamentals, the probability of sustained follow-through increases significantly. However, the market has not fully priced the worst-case scenarios yet. Oil remains volatile but not parabolic. Equity markets have shown stress but not capitulation. Bond markets are cautious but not panicked. That tells us investors are hedging, not yet fleeing. If escalation intensifies, hedging can turn into repositioning. Repositioning can turn into capital rotation, and capital rotation into hard assets can extend far beyond initial breakout targets. Some analysts are already modeling scenarios where gold moves far beyond current projections, if energy disruption becomes prolonged, or if global monetary authorities pivot toward renewed liquidity support to counteract recession risk. That's the inflection point. Will this remain a controlled geopolitical premium, or will it morph into a structural repricing of global risk that pushes precious metals into sustained multi-year highs? The answer depends on what happens next in oil markets, in military theaters, and in central bank policy meetings. In the final chapter, we will pull everything together: the military disruption, the energy choke points, the inflation dilemma, and the technical breakout, and translate it into actionable insight. Because understanding the shift is one thing, positioning yourself ahead of it is another. An urgent question arises: is this just another market spike, or the start of a structural shift in global risk? Now you've seen the full picture. Advanced military developments have shaken long-standing assumptions about deterrence. Energy markets sit on edge as strategic oil routes face renewed pressure. Inflation risks are creeping back into the system. Central banks remain constrained, and gold is challenging major resistance while silver builds momentum behind it. Individually, these factors create volatility. Together, they create alignment. The key takeaway is not panic, it is perspective. Precious metals are not reacting randomly. They are responding to a convergence of geopolitical risk, energy uncertainty, monetary fragility, and structural demand. When technical breakouts align with macro fundamentals, markets don't just move, they transition. So here's your move. Stay informed, think strategically, and evaluate your exposure to inflation, currency risk, and systemic uncertainty. Reflect on whether your portfolio is positioned for stability in an unstable world. If this analysis gave you clarity, share it. Start the conversation. Ask the hard questions about where gold and silver go next. Because in markets, just like in history, the biggest shifts reward those who recognize them early. Risk is being repriced. The only question left is whether you're watching it happen or preparing for where it leads.